13 Insurance in India, Chapter 13.1. Introduction. Insurance is a mechanism of risk management and protection that safeguards an individual against unexpected losses. Insurance is a contract between an insurance policyholder and an insurer. The policyholder pays a periodic premium or a lump sum to the insurer, and the insurer promises to cover losses of the policyholder/insured entity. Insured. An entity which provides insurance is called an insurer. An individual or entity who buys insurance is known as a policyholder, and the person or individual covered under the policy is called an insurance. Policy is a document/contract which gives details regarding terms and conditions under which the insurer will compensate the insured. Life insurance covers the life of an insured person, and the insurer pays a designated beneficiary a sum of money upon the death of an insured person. General insurance is an umbrella term for non-life insurance policies which covers other aspects and assets in a person's life, for example, health, car, home, etc. 13.1.1. How does insurance work? Working of insurance can be understood on basis of two related features. 1. Transferring of risk from one individual to a group. 2. Sharing losses, on some equitable basis, by all the members of the group. Insured entities transfer individual risk to a group where every member of the group faces a similar risk. Individuals substitute a large uncertain cost, in case of occurrence of an event insured against, with a small certain cost, premium. The premiums paid are pooled together, out of which the loss sustained by any policyholder is compensated. Thus, risks are shared with others, and many pay for the loss of unfortunate few. Insurance can also be understood as an instrument of loss distribution. What could have been a devastating loss for an individual is divided in an equitable manner among all the members of a group. Insurance protects through pooling of risk. When a large number of homogeneous entities exposed to similar risk are combined, risk is pooled and burden is shared. There is a very minuscule possibility that all the insured entities would simultaneously face the event insured against. It must be understood that insurance does not reduce the possibility of a loss-causing event, but it reduces the probability of financial loss due to that event. So, insurance, in essence, provides relief from the burden of the uncertain and not from the uncertain itself. 13.2. History of insurance in India. Ancient writings like Manu, Manusmriti, Yagnavalkya, Dharmasastra, and Kautilya, Arthashastra mention a system of risk-sharing similar to modern-day insurance. These writings speak of pooling of resources that could be redistributed in times of calamities such as fire, floods, droughts, epidemics, and famine, etc. Evolution of the insurance industry in the modern sense can be divided into three phases. The first phase started in 1818 with the establishment of Oriental Life Insurance Company in Kolkata, the first life insurance company in India. In 1829, the Madras Equitable began providing life insurance services in the Madras Presidency. These companies were operating in India but catered to the needs of the European community living in India and did not insure the lives of Indians. Gradually, some of the companies later started insurance services for the Indians, but they were treated as substandard. So, the Indian had to pay an ad hoc extra premium. Bombay Mutual Life Assurance Society, started in 1871, was the first company to sell policies at fair value to Indians. This phase was dominated by foreign insurance companies, such as Albert Life Assurance, Royal Insurance, Liverpool and London Globe Insurance, etc. Triton Insurance Company, established in 1850, was the first general insurance company in India. This was a British-owned and operated company. The Indian Mercantile Insurance Company Ltd., established in Bombay 1907, was the first indigenous insurance company. By the year 1938, more than 100 insurance companies were operating in India, but the sector was plagued by frauds and mismanagement of funds. A consultative committee under the chairmanship of Mr. Sushil C. Sun was set up by the Government of India in 1937. Finally, the first comprehensive law, Insurance Act, 1938, was passed to regulate both life and general insurance companies. The Insurance Act 1938 provided stability to the sector. This legislation resulted in a large number of insurance companies operating in India, and the level of competition was high. However, there were also allegations of unfair trade practices. The second phase started with the decision of the Government of India to nationalize the life insurance business in 1956 and the general insurance business in 1972. During the second phase, the insurance business in India was a public sector monopoly. An ordinance was issued on January 19, 1956 for nationalization of the life insurance sector. Life Insurance Corporation (LIC) came into existence under the Life Insurance Act, 1956. The LIC absorbed 245 Indian and foreign insurers. Nationalization aimed at 1. Overcoming the inefficiency and malpractices involved during the period of private insurance operations. 2. To make life insurance widespread under government control. 3. To restore public confidence and to ensure maximum security to the policyholder's capital. At the same time, nationalization also aimed at using the funds available with LIC for development under the 5-year plans. An ordinance promulgated on May 13, 1971 nationalized the general insurance business. 107 insurers were amalgamated and grouped into 4 companies, namely National Insurance Company Limited, the New India Assurance Company Limited, the Oriental Insurance Company Ltd. And the United India Insurance Company Limited. The General Insurance Business Nationalization Act, 1972, GIBNA, paved the way for the government to take over ownership of these businesses. For this purpose, General Insurance Corporation of India was incorporated to function as the holding company of the 4 companies and superintend, control and carry out the business of general insurance on behalf of the Government of India. With the liberalization, privatization, and globalization (LPG) reforms, the importance of private sector in deepening the insurance sector was felt. The process of reopening of this sector began with appointment of a committee headed by former RBI Governor Mr. R.N. Malhotra in April 1993 to propose recommendations for reforms in the insurance sector. The committee submitted its report in January 1994 and recommended that the private sector should be permitted to enter the insurance industry. Following the recommendations of the committee, in 1999, the Insurance Regulatory and Development Authority of India, IRDAI, was constituted as an autonomous body to regulate and develop the insurance industry. The IRDAI was incorporated as a statutory body in April 2000. The IRDAI opened up the market in August 2000 to private players with a foreign investment cap of 26% in equity shareholding. In December 2000, the subsidiaries of the General Insurance Corporation, GIC, of India were restructured as independent companies, and at the same time GIC was converted into a national reinsurer. Parliament passed a bill delinking the four subsidiaries from GIC in July 2002. With the private and foreign players' participation, the Indian insurance industry has transformed from a monopoly to a competitive market. To encourage private participation, FDI limit has been increased to 49% in 2014 and further increased to 74% in May 2021. As of December 2021, there are 34 general insurance companies and 24 life insurance companies operating in the country. The insurance sector is huge and is growing at a speedy rate of 15 to 20% per annum. Together with banking services, insurance services add about 7% to the country's GDP. India's largest life insurer, the Life Insurance Corporation of India, went public in May 2022, raising $2.70 billion in the country's largest IPO to date. The private insurance providers have also been seizing such opportunities. The insurance sector is witnessing mergers and acquisitions, M&A, activity as insurers have tremendous opportunities to coexist in the space. Additional FDI inflows, IPOs, simplified rules and regulations, and improved corporate valuations will further accelerate M&A activities in the sector. A rapidly maturing insurance market has also provided an opportunity to the government to privatize its stake in insurance business. Accordingly, the General Insurance Business Nationalization Amendment Act 2021 allows the central government to pare its stake to less than 51% of the equity capital in a specified insurer. To facilitate the penetration of insurance to lower income segments of the population, the IRDAI issued IRDAI Microinsurance Regulations 2015, which provide a platform for distributing insurance products that are affordable for the rural and urban poor and promote financial inclusion. Further, the IRDAI Obligations of Insurers to Rural and Social Sectors Regulations 2015 stipulate obligations for insurers in rural and social sectors and has contributed to developing and promoting microinsurance products in India. In FY 21, 10.7 lakh new microinsurance policies were issued to individuals with a new business premium of 355.3 Indian rupees crore in the life insurance segment. And 53,046 new microinsurance policies were issued in the general insurance segment, excluding standalone health insurers. As per the Swiss Re Institute World Insurance, inflation risks front and center report, India is one of the fastest growing insurance markets in the world. In total premium volumes, it was the 10th largest globally in 2021, with an estimated market share of 1.9% and the second largest Germany, Canada, Italy, and South Korea. Further, growth in the non-life insurance sector is likely to be driven by demand for health coverage, with people more aware of health security post-COVID-19 and strong support from the government-sponsored mass health program, Ayushman Bharat. Also, compulsory motor third-party insurance will multiply as India's middle class expands and buys more cars. Of all emerging markets, India is expected to emerge as one of the top 6 insurance markets in the world by 2032, ahead of 13.3. Insurance penetration and insurance density in India. Insurance penetration and insurance density are the two parameters used for measuring potential and performance of insurance sector. Overall insurance penetration in India moderated slightly to 4% in FY23 from 4.2% in FY22. During the same period, insurance penetration in the life insurance segment declined from 3.2% in FY22 to 3% in FY23. While it remained flat at 1% for the non-life insurance segment, overall insurance density increased from $91 in FY22 to $92 in FY23. In the life insurance segment, it rose from $69 in FY22 to $70 in FY23 and remained stable in the non-life insurance segment. 13.3.1 Reasons for low insurance penetration in India.
1.
Low average income results in greater proportion of income being spent on basic needs like food, clothing, housing, health, etc., leaving very little for saving and virtually nothing for paying insurance premium. 2. People generally lack financial literacy and are ignorant towards benefits of insurance. People often believe that they have wasted their money in purchasing insurance if a loss does not occur and indemnity is not received. 3. Increased number of private players and multiple schemes/policies offering various benefits for different premiums along with numerous add-ons have created confusion in the general public. 4. Most people continue to view insurance only as a tax-saving measure. Since just 2% of the population pays income tax, the number of persons inclined to buy insurance is also low. 5. There is also an element of distrust towards insurers among the public. For example, there seems to be a general perception that insurance comes with lots of terms and conditions that insurance companies misuse to reject even genuine claims. 13.4. Significance of insurance. The significance of the insurance sector in a modern economy can be understood at two levels. 1. At level of individual and enterprise. 2. At national and societal level. Insurance protects enterprises against insurance penetration. Insurance density. It is the ratio of total insurance premium paid to the GDP in a given year. It is calculated as the ratio of total insurance premium paid, in USD, to the population in a given year. Insurance penetration was just 4% of the GDP in the country in 2023, 2.71% in 2001. Insurance density in India was approximately $92 in 2023, $11.50 in 2001. In comparison, insurance penetration and in comparison, insurance density in countries like Malaysia and China was 4.72. Countries like Malaysia and China in 2019 and 4.3% respectively in 2019 were much higher at $536 and $430 respectively in India in 2023. Insurance penetration. In India, in 2019, insurance density for life insurance was 3% and for non-life insurance was $70 and for non-life insurance was 1%. Insurance was $19. Globally, insurance penetration for life globally. Insurance density for life insurance was 3.35% and for non-life was $379 and for non-life insurance was 3.88% in 2019. $439 in 2019. B. A. Figure 13.1. A. Steady increase in insurance penetration. B. Significant rise in insurance density. B. A. Figure 13.1. A. Steady increase in insurance penetration. B. Significant rise in insurance density. Unforeseen risks such as fire and natural disasters. Individuals require insurance services for financially safeguarding against loss of property, life, health care needs, etc. Insurance is assuming increasing importance in face of growing urbanization, declining social bonds, and rising cost of health care. Insurance also enables individuals and enterprises to undertake high-risk activities that can provide higher returns, thus promoting higher productivity and growth. Insurance encourages long-term saving, thus provides long-term capital for investment in developmental activities like infrastructure projects. It reduces the burden on the government exchequer by covering the needs of society. It helps in mobilization of saving and investing them in productive activities, economic growth and development of the nation. Insurance sector also employs a significant number of workers, helping to lower India's unemployment rate. 13.5. Government-sponsored socially oriented insurance scheme objective. Pradhan Mantri Jeevan Jyoti Bima Yojana, PMJJBY. PMJJY is a life insurance available to people in the age group of 18 to 50 and having a bank account. It provides a risk coverage of 2 rupees L against annual premium of 330 rupees.
Pradhan Mantri Suraksha Bima Yojana, PMSBY.
PMSBY is a personal accident insurance scheme that covers accidental death, permanent disability, and partial disablement. Scheme is available to individuals in the age group 18 to 70 years and having a bank account. The annual premium of the scheme is 12 rupees. 2 rupees lakh is paid to the nominee if the subscriber dies in an accident or if he is fully disabled. If the subscriber meets with an accident and suffers partial permanent disability, then 1 rupee lakh is paid. The annual premium of the scheme is 12 rupees.
Life cover under Pradhan Mantri Jan Dhan Yojana, PMJDY.
PMJDY seeks to provide a basic bank account to every family. The bank account comes with a rupee debit card with a built-in accidental insurance cover of 1 rupee lakh.
Pradhan Mantri Jan Arogya Yojana, PMJ.
Pradhan Mantri Jan Arogya Yojana, PMJY, is a health insurance scheme that aims to provide health cover of Rs. 5 lakhs per family per year for secondary and tertiary care hospitalization to over 10.74 crores of poor and vulnerable families, approximately 50 crore beneficiaries. From the bottom 40% of the Indian population, it is the largest government-funded health insurance scheme in the world. Pradhan Mantri Fasal Bima Yojana provides comprehensive Bima Yojana insurance cover against failure of the crop, thus helping in stabilizing the income of the farmers. It is a scheme of Ministry of Agriculture and Farmers Welfare. It covers A. Food crops, B. Oilseed crops, and C. Annual commercial/horticultural crops. The prescribed premium is A. 2% for Kharif crops, B. 1.5% for crops, and C. 5% for commercial and horticultural crops. Balance of actuarial premium is shared equally between state and central government. Pradhan Mantri via under the scheme, old age income security is provided Bandhana Yojana to senior citizens through the provision of an assured pension/return linked to the subscription amount based on a government guarantee to LIC. 13.6. Insurance Regulatory and Development Authority of India, IRDAI. The IRDAI, a statutory regulatory body established under IRDA Act, 1999. It was formed in response to the Malhotra Committee's recommendations. It has its headquarters in Hyderabad. IRDAI is a 10-member body including the chairman, 5 full-time and 4 part-time members. Appointed by the Government of India. Its functions and responsibilities include 1. Registering and regulating insurance companies. 2. Protecting policyholders' interests. 3. Licensing and establishing norms for insurance intermediaries. 4. Promoting professional organizations in insurance. 5. Regulating and overseeing premium rates and terms of non-life insurance covers. 6. Specifying financial reporting norms of insurance companies. 7. Regulating investment of policyholders' funds by insurance companies. 4. 8. Ensuring the maintenance of solvency margin by insurance companies. 9. ensuring insurance coverage in rural areas and of vulnerable sections of society. 13.7. Deposit Insurance and Credit Guarantee Corporation, DIC. Deposit insurance is a form of insurance that protects money of bank depositors in case of a bank failure or inability of a bank to repay its depositor. Deposit insurance premium is borne entirely by the insured bank. In India, a depositor can claim a sum up to a limit of 5 lakhs as insurance cover in the event of a bank failure, even if the deposit in their account is greater than 5 lakhs. As premium is paid by the bank, accounts are insured bank-wise.
So the
deposits kept in different branches of a bank are aggregated for the purpose of insurance cover, and a maximum amount of up to rupees 5 lakhs is paid. If an individual has deposits with more than one bank, deposit insurance coverage limit is applied separately to the deposits in each bank. The Deposit Insurance and Credit Guarantee Corporation, DCGC, provides for the insurance coverage. Deposit Insurance and Credit Guarantee Corporation, DCGC, is a subsidiary of the Reserve Bank of India and provides the deposit insurance coverage. It was established in 1978 under Deposit Insurance and Credit Guarantee Corporation Act, 1961. The Deputy Governor of RBI acts as its chairman of DICGC. It is headquartered in Mumbai. It provides insurance covers for all commercial banks, local area banks, regional rural banks, cooperative banks, and branches of foreign banks in India. However, the primary cooperative societies, non-banking financial companies, NBFCs, and mutual funds are not insured by the DICGC. DIC insures all bank deposits such as savings deposits, fixed deposits, current account deposits, and recurring deposits. It does not insure deposits of foreign governments in India, deposits of central/state governments with various banks, interbank deposits, deposits of the state land development banks with the state cooperative banks, any amount which has been specifically exempted by the corporation with the previous approval of the RBI. Reinsurance. Reinsurance is protection that an insurance firm buys from another insurance company to protect itself against the possibility of a major claim. Reinsurance is where a firm transfers its own insurance risks to another insurer. In most cases, the entity that purchases the reinsurance policy is referred to as a ceding company or cedant. The reinsurer is the institution that issues the reinsurance policy. 13.8. Miscellaneous 13.8.1. Hedging. A hedge is an investment made to offset potential losses or gains that may be incurred by an associated investment. To hedge, an individual invests in two different instruments that have adverse correlation. In simple terms, it is an investment made in a relatively safer instrument to reduce the likelihood of negative impact of loss from an investment in a high-risk instrument. It is a risk management that does not eliminate the loss, but decreases the impact of loss. 13.8.2. Bilateral netting. It refers to offsetting the claims arising from dealings between two parties to determine the net amount payable or receivable from one party to the other. Bilateral Netting of Qualified Financial Contracts Act, 2020 provides for a legal framework for bilateral netting of qualified financial contracts. This bilateral netting legislation helps in evaluating risks far more on a real-time basis, and actual risk assessment happens rather than a notional risk assessment based on the gross figures. 13.8.3. Domestic Systemically Important Insurer, DSI. DSI are insurers of such size, market importance, and domestic and global interconnectedness, whose distress or failure would cause a significant adverse impact on the domestic financial system. Therefore, the stability of DSIs is critical for the uninterrupted availability of insurance services in the country. DSIs are perceived as insurers that are too big or too important to fail, TBTF. This perception and the perceived expectation of government support may amplify risk-taking, reduce market discipline, create competitive distortions, and increase the possibility of distress in future. These considerations require that DSIs should be subjected to additional regulatory measures to deal with the systemic risks and moral hazard issues. 3 insurers have been identified as DSIs for the year 2021 to 22. 1. Life Insurance Corporation of India. 2. General Insurance Corporation of India. And 3. New India Assurance Company, Limited.